one way to construct the logic for the fundable startup and the approach that we're recommending, which is to create as much value in your company as you can before you approach investors. One way to create that argument is to think through carefully what it takes to manage investor risk. What can you do to reduce the risk that investors have to take in your proposition? Investors know they have to take risk, but they don't like taking a lot of risk all at the same time. They don't like having to take simultaneously the risk of developing the product, the risk that the product will work, the risk that it can be built for the price you say, the risk that customers will buy it at that price, the risk that it will solve their problem. That's just an awful lot of risk to expect investors to take in the early stages of a startup. So what you can do to reduce that risk is get your team and develop a product if possible. Implement the first version of your product. Try and get it in front of a customer. Try and do some beta testing so that you get some customer feedback and reduce that risk of customer acceptance. If you can work through those kinds of issues so that the only real remaining risk is the risk of scale-up. Can the company with some investment capital scale this up into a nationwide or worldwide business? That's the kind of risk investors like to take on, and it will greatly improve your chances of getting funded. Another very important risk that you might be able to eliminate is the risk of your business model. Your business model says, we think we can sell our product for this kind of price, we can manufacture it for this kind of price, so we can make this kind of profit, and we can do it with this much investment capital. The more you can prove out that fundamental business model before you approach investors, the better your chances of attracting capital.